Hello, this is Minder Chen. Welcome to the Entrepreneurship video series. In this lecture, we're going to talk about startup financing. Let's first look at some venture scale business. And a startup business needs to create and add value to customer, and they need to solve a significant problem based on the user's needs and want, for which they're willing to pay a premium to receive the product and service. We also want to see a good fit with the founder and the team that's working on the startup initiative. And for venture scale business, they like to see the potential for growth for the business to reach about 100 million revenue annually, and they certainly want the business to be very attractive with high multiple return for the investor. But where are the funding sources from? And here we list a number of funding sources. First of all, it's yourself. When you start a company, you may recruit and work with some co-founders to work together on the initiative. And initial money could be from your own saving and could also from your friends and family. The FNF, friends and family, they invested before anyone else with at the lowest price. And next is the angel investor. Here, by the way, all the number listed is just some average, and it may change over time. For angel investor, they would invest from 200,000 to $1 million in annually, and to multiple target. So they may invest $50,000 to your company or $100,000 to your company. It all depends on how interested they are in your business. The angel investor is very important. They invest their own money. Okay, it's not an institution investors. The venture capitalists or venture capital firms, they basically persuade other people to put the money in the VC fund, and then they invest that money, and usually start at $500,000 per company. Another it's probably shouldn't call the source of funding. The other people who has a stake in the startup firm are early employees who gamble on your company by accepting lower salary. However, you compensate them with some stock options. Okay, so they become part owner of the company, and they will be super motivated to see the company to be successful. Investment bankers usually get involved to help a startup firm once it has grown to go through the so-called initial public offering, the so-called IPO. They will handle the paperwork and try to sell the stock of the startup firms in the marketplace. The investment banker usually will get 7% of the whole IPO's value for their service. And people who purchase your stock in the market, in the stock market, will become a partial owner of your firms, which can be institute investors or individual investor in the stock market. So let's look at just a few examples. For instance, your family member, your uncle, you can give them 5% with some of their investment, and you use the money to register firms. You can go through some online service like LegalZoom. For $400, they will help you to register your company. Or you can pay a lawyer up to maybe $2,000 who may help you with set up your firms. And so you issue some common stocks. You give 5% to your uncle. You can set aside 20% of for your future employees. That is called employee stock option pool, or simply just called option pool. You will set up the option pool because some of your future institution investor will want an option pool as a condition of their investment, because they know that it's important to have option pool to attract talent to work for your firms. And also set it aside, that stock is safe from you or your co-founders to mess up with that share of stock. In startup investment, there's a term called valuation. Valuation is the value that an investor assigns to your business. If they can think that your company worth $1 million, $100 million when they negotiate their investment in your company. The valuation is total valuation of your company in their opinions. And it does not refer to any other type of valuation. And this actually valuation is related to the target ownership by the investor. The target ownership, for instance, they want to own 20% of your company. That's the target ownership percentage by the investors. And also the amount of money they would invest sometimes is calculated based on, at least partially, by the amount of the capital that required by your firms to reach the next major milestones before you need another round of fundraising. For instance, they will give you, if the company needs $1 million to reach, say, the product market fit, and then the investor may want 20% of your company. That means actually your firm's pre-money's value is worth actually $4 million. Okay, so the investor will invest $1 million, and your company's pre-money means before the investor's money, it's assessed to worth $4 million. So after money value will be that this 1 million plus the 4 million, which will be the 5 millions. And so the investors 1 million divided by 5 million will be 20%, which means they will own 20% of the firm after money valuation. So let's just give another example similar to what we have just gone through to help you to understand this pre-money valuation and post-money valuation. So if your company is valued at 1 million and an angel investors want to invest just 100K, and how much equity will this angel get? And so if the company is valued at 1 million post money, which means after we receive this 100K, then it will be the money invested by the angel is 100K, and after the post money value is 1 million, which is really 1,000K. It's 1 million, and that actually equal to 10%. So basically the angel investor will get 10%. Okay, we'll get to the 10% equity of the firms. Okay, so in this case, the angel assess your company will worth 900K before the investment. Okay, and the company will worth 1 million right after you receive the investment money. If the company is valued at 1 million pre-money before you receive the investment money, then the investors will get actually slightly a smaller percentage, in this case 9.09%. This is calculated based on 100K that is put in by the angel, and then the post money value, which is 1.1 million, and that end up to be 9.09%. Okay, so this is how it is calculated, and here we have the formula to calculate based on pre-money valuation or post-money valuations in terms of the equity. We mentioned employee stock option pool, simply called option pool, and this is used to compensate early employee that we hire, which usually we don't have a lot of money, so we sometimes pay below market salary. However, we compensate them with equity, which means stock options, to attract them to come and work for the company. Larger investors, VC firms, that usually require the creation of option pool. However, for seed run investment, around 100K, like angel investor, they would not typically require option pool to be set up. Okay, you can create the option pool immediately before the investment or after the investment. However, if you set it up after the investment, then the percentage of equity owned by the investors, including the new investor who put in the money, will be diluted. So you need to be aware of that. Whether you're going to set up the option pool before the investment or after the investment. As investors, if the option pool is set up before the investment, it's probably to your advantage. If after your investment, then your percentage you just receive will be diluted by a certain percentage. So let's look at how startup funding work based on this infographics, which you can find the original infographics here. And this certainly is a hypothetical case. And we did mention different type of funding source or investor, including yourself, the co-founder, friends and family, angel investor, venture capitalist, early employee, investment banker, or anyone in the stock market if you go through the initial public offering, IPO route. And here it's the money that you receive on this side through different round of fundraising, and this is the valuation over here of your company at the end when you go through the IPO. And in this case, the company, when you just started, you own 100%. If you're the sole author, you own 100% of the firm, but the company may worth nothing. So here we say 100% of nothing. At the end, once you have gone through the IPO, your equity percentage will be diluted. So the founders valuation will be diluted, in this case down to 17%. for really big firms. And however, since your total valuation is 2.6 billion, owing own actually 17% end up to be close to $500 million, which is $442 million. So instead of owning 100% of nothing, now you own a much smaller percentage of a company whose valuation is very high, and so your money, in terms of money value by dollar amount, is actually much higher than that 100% of nothing. So let's look at a little bit of the dilution, which means that you over time, you started with 100% ownership of the firm, your percentage will get diluted. For instance, if you have a co-founder, equal partner, you end up to have 50%. If you have friends and family, your uncle invests 5%. And also you set aside the option pool, so your ownership end up reduced to 37.5%. And if you receive funding from the angel investor, you give the angel investor 16.7%. Your equity reduced from 37.5% to 31.2%. If you got investment from VC, who take a huge chunk of a percentage, relatively speaking, close to 1/3, and then they own 33.3%. In this case, your equity reduced from 31.2% to 19.2%. And if you offer, let's say, 8.3% of your share of stock to the initial public offering, your final equity ownership will be 17.6% of the company. So you don't have the total control of company in a sense, but the VC may, if there's only one VC invest your firm, they may become the largest shareholder of your company in this case. But a lot of time the VC would team up other VC together to invest in your firm, so no VC may have more share than at least the two co-founders together. So dilution, we use the term dilution, dilute, which means you reduce the percentage of ownership. So for instance, after the angel run, to give out 20% of the ownerships for the angel who invested in certain amount of money, the founder owns 80%, the angel owns 20%. And now in serial A run, which is another round of investment money that you receive, if they require 25% for them to give you $1 million of money or something, in that case, your 80% will reduce to 100% minus that 25%. So your ownership will reduce to, in this case, 60%. And the angel's percentage will also reduce, in this case, the same kind of dilutions, which will be 20% times 75%, which end up equal to 15%. So let's look at the detailed calculation based on the hypothetical example earlier. So in this case, an angel investor invests seed money, which is $200,000 at 1 million pre-money valuations. So the post-money valuation will be this 1 million plus this 200K, which was 1.2 million, $1.2 million. So the angel investors' ownerships based on the post-money valuation. The post-money valuation would be this number, which is here, 1 million plus 200K, and then the angel invested 200K. So if you do the math, this will end up to be 16.7%. And the original option pool is 20%. So you time that 20% by 100 minus 16.7%, which end up to be just a coincidence to be 16.7% in this case. And the founder number one, the new equity percentage owned by one of the founders, initially is 37.5%. Now times 100 minus 16.7% end up to be 31.2%. So this is from 37.5% to 31.2%. The option pool will be 20% to 16.7%. Your uncle from 5% to 4.2%. Okay, the angel investors will get 16.7%. So this is how it is calculated, and you should make yourself familiar with this type of calculation. It's not as complicated as you may think. So dilution sometimes is in the startup and VC industry, it is called taking a haircut. Okay, for the original owners, such as founders, angel investors. So if you own 20% of a 2 million company, your stake is actually 400K. If you raise a new round of venture capital money, let's say 2.5 millions for 25% equity. So in that case, the pre-money value is 7.5 million, and the post-money value will be 10 million. So you give out 25% equity, which means that you dilute it by 25%. Okay, the 25% can also be calculated based on the post-money value, which is 10 million. And you divide the 2.5 million given by the VC divided by the post-money value, which is 10 million, which is 25%. So now your percentage of equity will be the original 20% times 100 minus that 25%, 100% minus that 25% that is given to the VC, which will end up to be 15%. So you reduce your percentage of equity from 20% to 15%. However, that 15%, the reduction of the percentage, now worth actually $1.5 million in the dollar amount, which means that the post money value, which is 10 million, times now your equity ownership percentage, which is 15%, that calculated into $1.5 million. So basically, the money that you have from the company is raised from that $400,000 to actually $1.5 million. Okay, so that's actually a pretty good deal. Paul Graham has a short article which you can check it out here on equity equations. Basically, he argued that the value of the ownership after dilution in terms of ratio, okay, here I call it multiple of valuation increase, should be greater or equal to 1 minus n, where n is the amount of ownership that you give up. So if you give up, let's say 50%, in that case 1 minus 50%, which is half, so 1 divided by 1/2 equal to 2. So if you give up half of your equity, and the values of the firms, or the valuation of firms, should increase at least twice for it to be worthwhile. The actual number probably should be even higher than 2. Okay, so here he used Y Combinator, which is an incubator program he founded. Let's say Y Combinator take when you are accepted to Y Combinator to their incubation program, they would take 6% of the company. In this case, the n is 0.06, which is 6%. And so if you use this formula, the multiple of the valuation increase should be 1.0664. Okay, so if your average outcome or valuation increase is anything more than 6.4%, if your percentage of increase is more than, not the multiple, the percent of increase is more than 6.4%, which is coming from here, then it will to some extent make sense. So if somehow going through the Y Combinators, your outcome increased by 5%, you are net ahead, as said here, because the remaining 94% that you hold is now worth actually this 94% times the new valuation, which is 1.1 multiple of the original. Okay, here Paul Graham did not use like your initial value is 1 million, assuming your initial value is 1 million, and so that this 1.1 times that 1 million will be 1.1 million. So now you own actually $1.034 million instead of the original $1 million. Okay, so this is certainly a hypothetical case. So you can, in this case, if a bigger VC firm like Sequoia that takes about 30% of the company, which means that the multiple of valuation increase is 1.43. So if they can actually improve your outcome, your valuation by more than 43%, then it's worthwhile potential to consider their investment. VC firm like Sequoia try to limit their holding to leave the founder enough stocks or ownership percentage to feel that they still own the company, have the control of the company. Let's talk a little bit of incubators program and angel investor a little bit. We mentioned Y Combinator, which is example of incubator program, and sometimes it's called accelerator. And there's another term people just called excubators. They often this type of organization usually place they offered cash co-working space, and they offered advisor who are probably experienced entrepreneur themselves to help you to shape your business model. They don't give you a lot of money. Here they say the cash is tight, which they give you about 25K and ask for about 5 to 10% of your firms. However, the advisors from the incubators or accelerator program a lot of time are worth more than the cash that you receive. Paul Graham, we mentioned earlier, at Y Combinator is known for giving really good advice to some of the startup firms they adopted into their accelerator programs. And they also have the connection. They would connect you with VC firms. They will have the so-called demo day for their for the startup firm that work under their supervising to actually pitch to the VC firm and potentially get additional investment money, say 3 months after you have been adopted to the program. And since 2014, Y Combinator actually up their investment amount, which was 120K for 7% of the equity. It's probably partially because they're located in Silicon Valley, and living in Silicon Valley now become very expensive. So they want to have enough money to cover your living expense for all the founder, the original employee, to be able to work seriously and very concentrated on their product or service and building it up for at least 6 months. They don't charge any fee to the company which they adopted, and they have no anti-dilution term. Anti-dilution means that if you receive additional money, then you're not going to dilute their percentage. They don't have the anti-dilution term because the anti-dilution firm, if there is one, which means then other owners like the founders will be diluted much more than usual. The angel rounds and the seed round sometimes are called pre-Series A. Series A funding. We have Series A, B, C, etc. So this is pre-Series A funding, which include angel round and seed round. Seed round is often after the angel round. It doesn't mean that you have to go through all those steps, but this is just some common term you want to be familiar with. And seed round is a round where there's potentially a VC leading this round of investment by collaborating with other VC firms, so they can kind of spread the risk around. They will price and assess your valuation accordingly. And also angel investor may participate in the seed round. Their typical rate, you may raise 750K or close to $1 million of investment money. However, typically the investor required to see some level of tangible traction, which means you have enough customer that you attracted, you have high growth rate in terms of your customer acquisitions. And so make sure that you have some tangible traction that you can show to this type of investors. And most of the company have to raise an angel round from individual prior being able to raise seed rounds from institutional investors. And the money that you raise will provide the runway necessary to achieve the tractions, okay, more solid tractions. And that's what most of the institutional investors are looking for when they are doing a seed financing. So what does the runway means? Here's the explanation. Runway simply just say that how long can you last in terms of burning the money that you have on hand before you go out of business or before you turn into profit. Okay, and so to calculate the runway, usually it's calculated in terms of the amount of time, in terms of number of months, and until you go out of business or until you really need to raise another round of money. It is related to the burn rate. So what is burn rate? Burn rate basically means how much money that you spend per month. The kind of net negative cash flow. Assuming when we emphasize it's not just the money you spend, but also it's basically your income. At the startup stage, your income probably will be negative, so you will have a negative cash flow. So per month, and so this cash spend means that negative cash flow, the cash you spend per month, considering the revenue that you generated and the money you have to spend together. It's the net cash flow. Assuming, for instance, your goal is really try to use this runway, use the money that you receive by the investor and the runway that established, which means give you 6 months or a year for you to grow your business to turn into profit. And so you want to handle your the cash flow very carefully, reduce your burn rate to extend your runway at the same time. So in this case, you do want to generate positive cash flow from your operation. In this case, will be then your company will be self-sustaining. In that case, you don't really need anybody's investment unless you really want to rapidly grow your business by invest a lot in marketing and sales. Otherwise, if you cannot generate positive cash flow, you may need another round of financings. Okay, so burn rate is a measure of negative cash flow, usually per month. Okay, so assuming your burn rate is 100K, assuming that the company, your startup firm, has 1 million on hand, that means that your runway will be 10 months. So you can last for 10 months, assuming everything is equal. Assuming you're not turning the negative cash flow stay the same. A run. After you have your seed money and you can use the funding resources to grow your business, to build out your products, etc., to scale it up and start to get momentum with the users. Then you want to consider A round funding, and the amount of money typically is larger. They're at least $1 million, $5 million, or even $10 million. However, the investor want to see a very specific strategy that makes sure you have the product market fit and you have very focused target audience in terms of the timing, the revenue streams, and your future plan and the exit strategy. Okay, such that the investor can make their money back. And the exit strategy, which we'll discuss, which means that you either go through the IPO route and make initial public offering to offer stock in the public market, or actually be acquired by other firms. Guy Kawasaki, in his book called The Art of Startup, kind of make an analogy in terms of this different type of fundraising steps. He calls seed money called CISO. Okay, and it's from friends, family, and angel. You're selling on dreams. Usually, in his opinion, it's 100K to 250K. Series A is a steak. Okay, so where's the beef? Which means you want to be able to generate the revenue. Okay, and usually their venture capital VC firms enter into the picture. Their bet on you amount to $1 to $3 million, which means they will give you $1 to $3 million for Series A investment. And it could be followed by a so-called Series B. In this case, Guy called it steroid, which means the customer are buying your product and service or eating your product and service. In the startup culture, we call this the dogs are eating the dog foods, which means they are really using your product and services. You're generating some revenues out of that. So the company need an injection of that additional money to get the magical 100 million a year revenue rate. So you spend a lot of money that you receive from this round of investment to grow your business, to scale it up more dramatically. Serial seed called sycophants, which means basically you don't really need the money. You probably already have a positive cash flow. However, you still want kind of additional money in the bank, cash in the bank to prepare for the worst, just in case there's some huge economic downturn. You have the money to survive the winters. And so company like Google, Apple, Amazon may actually take the Series C's money when they started. Okay, in this case, you're not really selling to the VC firms. They usually are kind of begging you for them to invest because you already have a well-established and proven business model and are cash positive. We mentioned exit strategy. A lot of young founders are surprised by the investors when they ask, like, what's your exit strategy? And personally, I found that the thinking of an exit strategy at the very beginning to be unusual, in my humble opinion, because you're so involved in and love what you're working on. It's like your baby. How can you sell your baby? However, this is very common. Okay. And because the investor needs to get their capital they invest in you back, so they will only consider company they have an exit strategy. So if you can certainly come up with an exit strategy. Usually there are two ways. One is getting bought by other firms through merging or acquisition, or go public, which is through IPO, initial public offering. For VCs, early stage investors, angel investor or VC, since the startup business is a high risk business, they really want really high return, 10 times return, okay, 10x return, a multiple of 10x. So for instance, if an investor invests 100K in a 1.1 million post-money company, when the company need to exit at 11 million to create that 10x return. So the company need to be sold when it exit at $11 million valuations. Okay, so for hypothetical 200K post money, then the exit need to be 2 million. The late stage investors usually expect a 3 times return on average, which is 3x return on average. Okay, thank you for listening. We will continue startup financing in another segment of lectures. So see you soon. Bye bye.